Here's a figure that should stop you in your tracks. Italy is sitting on a public debt worth roughly 139% of its entire economy, the second highest ratio in the Eurozone after Greece. And yet, in June 2026, investors are charging Italy less to borrow than at almost any point in 15 years. How can a country that owes so much suddenly look like such a safe bet? That contradiction sits at the heart of Italy's financial story this year, and because Italy is the Eurozone's third largest economy, what happens in Rome doesn't stay in Rome. It ripples straight across the continent. Stick with me, because by the end of this video you'll understand exactly why economists across Europe are watching Italy so closely right now. First, let's set the scene. Italy isn't a small player you can quietly ignore. It's the third largest economy in the Eurozone, behind only Germany and France, and a founding member of the European Union. When Italy sneezes, the single currency catches a cold. The reason is its sheer size combined with its enormous debt pile, well over 2.5 trillion euros. Italian government bonds, known as BTPs, are held by banks, pension funds and insurers right across the continent. So if confidence in Italy wobbles, the shockwaves hit French banks, German savers, and the European Central Bank's balance sheet alike. This is why the so-called spread between Italian and German borrowing costs is treated as a real-time stress gauge for the entire Eurozone. So how is the Italian economy actually performing in 2026? In a word, modestly. Real GDP is forecast to grow by around 0.5% this year, hardly a boom, but importantly, it's still growth. Much of that momentum is being driven by investment funded through the EU's Recovery and Resilience Plan, part of the wider NextGenerationEU program. Those EU billions are flowing into infrastructure, digital projects, and green energy. The flip side is that household spending is slowing, because rising prices are quietly eroding people's purchasing power, and weaker exports are dragging on the headline number. The picture, then, is one of an economy ticking along on EU-fueled investment rather than firing on all cylinders, resilient, but fragile. Now to the headline worry, the debt. Italy's government debt reached 139% of GDP in the first quarter of 2026, up from around 137% the previous quarter, and forecasts suggest it could edge towards 139.2% in 2027. To put that in plain terms, for every euro the Italian economy produces in a year, the state owes nearly €1.40. This is a legacy problem, built up over decades of high spending and sluggish growth. It matters because servicing that debt, simply paying the interest, swallows a huge slice of the national budget every year, money that can't go to schools, hospitals, or tax cuts. Bringing this mountain down, even slowly, is the single biggest test facing Italian policymakers. Here's where the story gets genuinely surprising. Despite that towering debt, markets are remarkably calm. The BTP-Bund spread, the gap between what Italy and ultra-safe Germany pay to borrow over 10 years, dropped to just 59 basis points in January 2026. That's a 15-year low. Italy's 10-year bond yield has fallen to around 3.64%, the lowest in months. So what's going on? Investors are rewarding two things: signs of steady, predictable growth, and the government's visible commitment to controlling its deficit and respecting EU budget rules. In financial markets, credibility is everything. By doing what it says it will do, Italy has earned a level of trust that, frankly, would have seemed unthinkable during the debt crises of the past decade. It's not all good news, though. Two pressures deserve a closer look. The first is the deficit, the yearly gap between what the state spends and what it earns. It's projected to fall from 3.1% of GDP in 2025 to 2.9% in 2026, finally slipping back under the EU's symbolic 3% ceiling. That's a meaningful step in the right direction. The second pressure is inflation. A sharp rise in energy prices from March 2026 is feeding through into the wider economy, pushing headline inflation up to around 3.2% this year. For ordinary Italian households, that means higher bills and squeezed budgets, which is precisely why consumer spending is cooling. Energy, once again, is the wild card hanging over Italy's recovery. There is one genuinely bright spot, and it's the jobs market. Italy's unemployment rate is set to fall further to around 5.7% in 2026 and 2027, historically low for a country that has long battled high joblessness, particularly among the young and in the south. But there's a twist worth understanding. Part of this improvement isn't roaring job creation, it's demographics. Italy's working-age population is shrinking as the country ages and birth rates stay low. Fewer people seeking work mechanically pushes the unemployment rate down. That's a double-edged sword, lower unemployment today, but a smaller workforce tomorrow to generate the growth needed to pay down all that debt. It's a structural challenge no budget can fix overnight. So where does this leave us? Italy in 2026 is a study in fragile confidence. The fundamentals are sobering: debt near 139% of GDP, growth of just 0.5%, and inflation biting into household budgets. Yet markets are calmer than they've been in over a decade, the deficit is back under control, and EU recovery funds are keeping investment alive. The key takeaway is this: Italy has bought itself credibility, but credibility is fragile. It depends on the government sticking to its plan and on energy prices not spiraling. If it holds, Italy stabilizes and the whole Eurozone breathes easier. If it slips, those low spreads could reverse fast. For anyone watching the European economy, Italy remains the country to keep your eye on. If you found this useful, do consider following the channel for more clear breakdowns of the stories moving Europe's economy.